Hey guys, what's up? Welcome back to My Financial Focus. In today's video, I wanted to talk about a different type of financial model that I have not introduced on this channel yet, and that is the dividend growth model. So as we can see right here, I'm using Coca-Cola stock as an example in this video because they're pretty famously known for being a pretty good dividend paying stock, and so this would be a good stock to use as an example for this video. So first and foremost, let's talk about what the dividend growth model actually looks like in terms of what the actual equation is. So we can see right here on the right, I've set it up here pretty boldly. We can see it says share price equals dividend next year divided by the discount rate minus the dividend growth rate. And so basically what this model is trying to figure out is it's basically looking at a company as the cash flows that are coming from their dividends, just purely looking at the cash flows coming from their dividends. So it's kind of similar to the discounted cash flow model in that it's really just boiling a company down to the future cash that an investor is going to collect from these dividend payments that the company is paying out to their shareholders. And so for this first part of the equation, the dividend next year, sometimes we're able to just go on Google and find the dividend that a certain company is planning to pay out to their investors for the next year. But if we're not able to do so, then we can use this equation right here. And it's kind of small. I don't really know how to zoom in here. But basically, what it says is we're basically just going to take the current annual dividend. So this is the dividend that a company would have paid like in the trailing 12 months for the last year or so. And we're basically taking that and then we're multiplying it by the projected growth rate for the annual dividend. So in this case, I have an annual dividend growth rate of 2.44%, which basically means that from now till next year, the current annual dividend of $1.76 per year is going to grow by 2.44% to the next year. And so the way we calculate that is pretty self-explanatory. It's just the same way we always calculate interest, like a certain sum of money collecting interest moving forward. We just do $1.76 multiplied by 1 plus whatever the annual dividend growth rate is. So 1 in this case would be the actual whole current annual dividend, and then we're adding the annual dividend growth rate, in this case 2.44%. That way, once we multiply that by the current annual dividend, we can figure out what the current annual dividend would be in terms of an actual dollar amount after the annual dividend growth rate is added on to the current annual dividend. Then after that, we're just dividing it by the discount rate, which is essentially the expected rate of return as investors that we're expecting to receive from this investment or that we want to make from this investment. So in this case, I just put 10% because that's just what the S&P 500 over a long period of time has averaged annually. So if we want to get at least a 10% return per year, then that would be the discount rate that we would use for our intrinsic value equation, or in this case, a dividend growth model. And then we would just subtract the annual dividend growth rate from the discount rate as part of the denominator of our equation. And once we have that, we just have the dividend next year divided by whatever the discount rate minus a dividend growth rate is, and that gives us our intrinsic value per share. And so it's a pretty self-explanatory model. It's a lot simpler to use than the discounted cash flow model, which could be good and could be bad, which I'll get into in a little bit here. But I also wanted to look at the metrics that I used for Coca-Cola in this case. We can see if I go to Yahoo Finance for my example, Coca-Cola has pretty much been increasing their dividend by about 1 penny every, or not 1 penny, but like 1 penny every single year consistently for a pretty long time. We can see for the first year, quarterly payments of 42 cents, then 41 cents, 40 cents, 39 cents, and so on, 37 cents. So they've been increasing their dividend pretty consistently, which is why using Coca-Cola in this example works really, really well. And so also we see right here that the 1 year dividend growth rate for the trailing 12 months was 2.44%. And so I basically just used that in my equation in order to try to figure out what the dividend next year would be. I just took the current annual dividend, which I got from looking at the dividend yield, which is, as we can see right here, where is it? 2.61%. So we just take 2.61% and then multiply it by the share price of Coca-Cola, and that gives us the current annual dividend. And then I just multiplied that by the 1 year trailing 12-month growth rate, and that gave me the projected dividend that was going to be paid out in the following year. And then, of course, for these other two metrics, this is pretty simple. I basically just, for the 30% margin of safety, I took 70% of the intrinsic value per share. And then for the 50% margin of safety, I just took 50% of the intrinsic value per share. And that's basically how this model works. And we can actually see that if I compare this model to the discounted cash flow model that I use in like almost all of my stock analysis videos, we can see that the intrinsic value per share actually wasn't that far off from model to model. For the discounted cash flow model, it came out to be about $28 per share with a 30% margin of safety of $19 per share and 50% margin of safety of $14 per share. And if I compare that to the dividend growth rate model, we can see that it's pretty similar, 23 to 28, 16 to 19, 11 to 14, so it's pretty close. And for this discounted cash flow model, I got these numbers from Yahoo Finance as well. These growth rates I got from I think this is the analysis tab right here, 7.09%, and then the actual like year one free cash flow I got from TradingView, and then the net cash minus net debt, as well as the shares outstanding I got from the statistics tab, as we can see right here. So according to these values, I mean, it would seem like the dividend growth rate model and the discounted cash flow model seem to put out pretty similar metrics. But obviously, there are some limitations to the dividend growth model. I mean, for starters, it assumes that the company will basically last forever. I mean, maybe the company will be liquidated in the future. And in that case, obviously, we're not going to be able to compound the future dividends at this growth rate forever. So then this model would pretty much be obsolete at that point. And then also it assumes that the company's dividend will continue to grow at the estimated annual growth rate forever. So, I mean, sometimes companies don't grow their dividends. Sometimes their dividend decreases from year to year. So if that does happen, then that also makes it so that this model can't really be used as accurately to figure out the intrinsic value per share of a company's stock price. Also, it assumes that a company won't cancel their dividend in the future. There are some cases where companies will pay a dividend to their shareholders originally, but then later on, as to some restructuring or some differences that, or some like, I don't know, sometimes companies just change and they don't really want to pay a dividend anymore. They want to reinvest those earnings back into the company. And so, or maybe they just go bankrupt or something like that. There are a lot of different reasons why a company might stop paying their dividend. And so if that does happen, then obviously a dividend growth model won't really work. And then lastly, of course, this model obviously can't be used for companies that don't pay dividends, like some of these bigger tech companies like Twitter or Meta or Alphabet. They don't really pay dividends. They just sort of keep their earnings and retained earnings and reinvest them in R&D in the future to try to provide value to their shareholders in that way. So there are some limitations to the dividend growth model, just like there are limitations to the discounted cash flow model or really any financial model that we use to try to value the stock price of different companies. So I'd say that it's not a perfect model. I mean, both models aren't really perfect, but they can be used as tools for reference when we're trying to figure out the intrinsic value per share of a company's stock price. So that basically sums up everything in this video. I just wanted to touch on the dividend growth model so that anyone who's watching this who's comfortable using the discounted cash flow model could also sometimes maybe use this model and then compare the intrinsic value per share of the two models to try to figure out the intrinsic value. That's it. Leave a like on the video, subscribe to the channel, and I'll see everyone in the next one.